Hey everyone, welcome back to Corporate Decoder. Today we are diving into a real estate income company's report, and let me tell you, there are some interesting distributions happening that might put some cash in your pocket, or maybe just remind you that not all shares are created equal before we get into the juicy details. If you are here for crystal clear explanations of complex financial documents and want to skip the jargon, make sure you are subscribed. And hey, if you like these deep dives and want to chat with us and other corporate enthusiasts, join our Discord community. The link is in the description below. Alright, so we are looking at a filing from InPoint Commercial Real Estate Income Incorporated. It's a type of report called a Form 8K, which usually means something significant has happened that the company needs to tell investors about right away. Today's filing is all about distributing some cash to shareholders. Think of it like the company saying, hey, we made some money and we are sharing the profits. The main story here is actually about distributions to different classes of their common stock. They are sending out a payment to shareholders who own the stock on the 30th of November 2025. Now this is where it gets interesting because not all shares are treated the same. For Class A common stock, Class I common stock, and Class P common stock, the gross distribution is $0.1042 per S-share. And importantly, there are no stockholder servicing fees for these classes. So what you see is what you get, a clean $0.1042 per S-share going straight into your pocket for each share you hold of these classes. It's a straightforward and transparent distribution for these shareholders. Now, Class D common stock gets a slightly different treatment. The gross distribution is the same, $0.1042 per S-share. However, there is a stockholder servicing fee of $0.0032 per S-share. This means the net distribution for Class D shareholders comes out to $0.101 per share, so you get a little bit less compared to the other classes because of that servicing fee. It's a small difference per S-share, but it's something to be aware of. Then we have Class T common stock. Similar to Class D, the gross distribution is $0.1042 per S-share, but here the stockholder servicing fee is a bit higher at $0.0108 per S-share. This results in a net distribution of $0.0934 per S-share. This class sees the lowest net payout among the common stock options due to the higher servicing fee. It definitely highlights how different share classes can lead to different outcomes for investors. These net distributions, remember, that's the money after any fees are taken out, will be paid out in cash around the 17th of December 2025 to those who own the stock on the 30th of November 2025. So if you are holding these shares, keep an eye on your account around mid-December. But wait, there is more. The company also authorized a dividend payment for their preferred stock, specifically the 6.75% series, a cumulative redeemable preferred stock, which trades on the New York Stock Exchange under the ticker symbol ICRPRA. On the 26th of November 2025, the board approved a quarterly dividend payment. Holders of this preferred stock who owned it on the 15th of December 2025 will receive a dividend of $0.421875 per S-share. This dividend is scheduled to be paid out on the 30th of December 2025. Preferred stock dividends are generally more stable and predictable than common stock distributions, often seen as a fixed income component within an equity investment. Let's put on our Warren Buffett hat and think about what this all means. On the surface, these are straightforward distribution events. The company is sharing profits, which is generally a good sign. However, the differences in net distributions between the common stock classes are quite telling. It shows a tiered system where some investors are bearing more costs than others. For Class D and Class T shareholders, the servicing fees eat into their returns. While these amounts might seem small on a per-share basis, for investors holding large quantities of stock, it can add up. It also raises questions about the value proposition of holding those specific share classes, especially Class T when compared to Class A or P. The fact that they are making these distributions is positive. It suggests the company is generating enough cash flow to reward its shareholders. However, we don't have the historical data in this specific filing to compare these distribution amounts to previous periods or to the company's overall performance. Typically, we'd want to see if these distributions are growing, shrinking, or staying the same, and how they relate to the company's earnings and assets. One key risk, as mentioned in their standard cautionary note, relates to blind pool offerings and best efforts offerings. These terms suggest that the company might be raising capital for investments without having identified specific assets yet, or selling shares with no guarantee of selling all of them. This can introduce a higher level of uncertainty and risk for investors. They also mention risks related to borrower defaults and changing interest rates, which are common concerns in the real estate income sector. If borrowers can't repay their loans or if interest rates make financing more expensive, it directly impacts the company's profitability and its ability to make distributions. Looking at the structure of these distributions, particularly the variation for different common stock classes, suggests a complex business model. Companies often create different share classes to cater to different types of investors, perhaps with different fee structures or voting rights. While this can be a useful strategy, it can also lead to confusion and create perceived inequities among shareholders. For investors, it's crucial to understand exactly which class of stock you own and what its associated fees and benefits are in terms of company direction. InPoint Commercial Real Estate Income Incorporated seems focused on distributing generated income to its shareholders. The existence of preferred stock with a fixed dividend suggests a strategy mix of stable income generation and capital appreciation or yield generation from its common stock. The primary opportunity here is the potential for investors to receive regular income, especially from the preferred stock which offers a fixed dividend. However, the risks associated with real estate investments and the specific mention of blind pool offerings mean that potential returns come with a notable level of risk. In conclusion, this filing is primarily an announcement of cash distributions to shareholders, highlighting differences across various stock classes. While the distributions themselves are a positive signal, investors should pay close attention to the associated servicing fees and the broader risks outlined by the company, such as those related to blind pool offerings. The company's strategy appears to be focused on income generation and distribution, but understanding the nuances of each share class is paramount for maximizing returns and mitigating potential downsides. Alright, that is our quick decode of InPoint Commercial Real Estate Income Incorporated's latest update. What is your take on these distributions and the varying net payouts for different stock classes? Do these kinds of fees concern you? Drop your thoughts in the comments below. If you found this breakdown helpful, please hit that like button, it really boosts our channel. And of course, subscribe for more straightforward looks at corporate finance. Don't forget to check out the Discord link in the description for more discussions. Thanks for watching, and we will see you in the next video.